All right. Well, I'll tell you what, I show us at a minute after the hour according to my Mickey Mouse watch, and I bet John's and Melissa's agrees with it as well. So
Yep.
we're going to go ahead and get started, knowing that we might get a few other people that are going to be logging on. We had pretty good response to this series of sessions. Really happy to have John Gibbons with us. John, as many of you know, is our dear friend from Mutual of Omaha. We work with John a lot. Not only does he make himself available for events like this, he's a constant resource for us for anything Mutual of Omaha related, and is just a terrific support mechanism for us and a great partner from the carrier point of view with Mutual of Omaha. So we certainly appreciate everything that he does for us, and today is no exception, as are the next couple of weeks going to be no exception. This, as you've probably gathered from the information that we shared and the registration, this is part one of three. John has been doing facsimiles of this for other groups as well, and we thought, man, this would be good for us to make available because without getting into the weeds too much, our composition of our producers out there ranges from people who are really expert in long-term care planning and long-term care insurance to, on the other end of the spectrum, people that aren't really sure how to spell LTC. So it helps to have a barometer of sorts to have a starting place, I guess, is the better way to put it. Of, okay, how do I have the conversation? How do I even get started? How do I get out of the blocks to have this conversation? I get that it's important, but how do I do it? So we decided to enlist John's help to give us kind of the how-to foundation for each of you who may find that of interest. And based on the number of people who registered and who are still getting on, sounds like that was a winning formula. So we're hopeful that those of you who are with us today will not only sit in today, but you've registered for and will sit in for the next couple of weeks as well, where John will do variations on a theme. And I don't want to steal his thunder, so I'll let him describe what you have in store for you, not only today, but over the next couple of weeks as well. As you probably have gathered, we have this type of long-term care content going on all throughout the month of April. We're actually taking long-term care as a topic into the month of May. And really, our design here in part is to lay the foundation for our long-term care carrier days that we will be rolling out in the first 2 weeks of June here in New York and Pennsylvania predominantly. So we already have the registrations coming in for those events. Those of you who are in the area, we certainly look forward to, hopefully you'll be able to join us. Um, and this is kind of a preface to what we're going to be talking about that day, only we'll take a little bit different direction there. So as we typically do, just to get the housekeeping out of the way, we're recording the session today and we'll have this loaded up on the training page at our website, as we will for the next two that John does for us here. It usually takes us a couple of days to kind of reformat it and get it placed up there for you. And so feel free to revisit it, share it with your colleagues, and look forward to having everybody for the balance of these, as well as for the carrier day. So if you're signing up for this and you've signed up because of the e-newsletter, there is a link in the e-newsletter to register, get more information for those carrier days. Melissa is here with us as well. Most, if not all of you, know Melissa Frazier, our long-term care brokerage director. She's running quarterback on that particular event as well, as she has in the past, so she can answer any additional questions you might have as well. So, hey, I'm going to be quiet now. John, once again, really appreciate you carving out some time for us today. We do have the lines muted, everybody, but this isn't everybody's first Zoom rodeo either. So if you do have questions, go ahead and type those into the Q&A box, and we'll make sure that we get to those at the end of John's prepared comments. So, John, great to have you here. I'll let you introduce things a little bit more as well as yourself. Go ahead. I'll turn it right over to you. Take it away. The floor is yours.
All right. Thank you very much, Bob. If any of you by some chance are new to New York long-term care, you're looking at an organization that one is a great partner of ours, but you have nothing but seasoned veterans here. Obviously, Bob, familiar with all products. Melissa is a superstar with long-term care, and they have all products, right? And she knows all of them and where they fit and how they fit and that type of thing. So you're in great hands here. So, we had a discussion early this year, whatever, on different ways of growing things and educating people. And we came up with this concept of this trilogy. So what we want to do is start today. We know most people out there don't know how to position long-term care, right? There are staffs out there, we may touch on some of these on the need and the gap and stuff like that. But many times what agents do is they call in to Melissa or whomever and get an illustration. You go out, show the illustration, and just walk through that. That's it. And then the client goes, it's too expensive. And then you blame the carrier because you didn't do anything other than walk up to an illustration. So what we want to do is one, walk you through the product in depth today so that you can speak better to it and the value of this product. All right, everything it does. You won't hear it's too expensive when you lay out the value. So we're going to touch on that today. Then we're going to follow it up with how to have the conversation and how to set the stage and what the risk is and things like that, that you'll have a comfort level then of how to position this up front and the need and be able to maybe even develop your own elevator speech. And then the third session will be how to craft an illustration and how to design it by demographic. And that makes a huge difference, all right, in how you design it. And we'll get in depth with that. So let's go ahead and jump in today. Just a quick thing here on the need and the cost. All right. Now, you're in New York, right? Or many of you are, or in the Northeast. It could be all over, but um, New York, New Jersey, Connecticut, it's very expensive, more expensive than what I'm going to show right here. So we're showing nationally like 127,000 for a private room, 70,000 for an assisted living, 62,000 for home care. All right. Key is we're not trying to solve for those numbers. All right, at least not for this. Most care is given at home. All right, not in a nursing home if you have a policy. All right. But here's why I'm showing that on our um, sales professional access site. If you're familiar with that, appointed with us, you can go in and look at our calculator and it's going to tell you, you can click down and hit whatever state you're in. Let's say it's New York. And yes, we have the product in New York, obviously. And then you can put out here, all right, let's say I'm talking to a 55-year-old in the sweet spot. Well, you might want to write this down. The average claimant is age 80. And you're going, well, why am I buying it at age 55? You want to buy it while you're younger, while you're healthy, and it's less expensive. If you wait, there's a risk of uninsurability. All right, and it's going to get more expensive. But if you go into the sales professional access, you can go in here and hit 25 years out and show somebody, hey, 25 years from now, this is your cost nationally. It'll be probably 300,000 plus, New York area, Northeast, 155,000 for home care. What's that going to do to your portfolio? All right, so that's where the thought is here. So now let's kind of get to the basics of a product, and then we'll get more in depth. You have four working parts. Now, so you got your monthly benefit, number of years, inflation, and elimination period. So this is the basics. I know some of you on here are probably seasoned veterans. Hopefully you'll still get some golden nuggets as I go through it. So bear with me in the beginning here. But so I have a monthly benefit. That's how much is Mutual of Omaha going to pay me while I'm on claim? And that's a subjective number, and that's where Melissa and the team can help design that. A lot of times, in the most of the country, I use like $5,500 a month. I'm not sure what Melissa uses, but let's just say in the Northeast, I might use $6,500 a month or so, give or take. All right, and this is subjective. Melissa knows that area better than I do. Follow her lead for that. But so I have a monthly benefit. And so we figure what that is. And then I want to go, how many years do I want Mutual of Omaha to pay for my care? Do I want to have enough for 2 years, 3, 4, 5, 6, 7? All right. So let's just say a lot of times I tell if you're dealing with upper middle class, let's go with 3 years and a 4 year. Show them both. So let's just say I have a 3 years I pick. So what happens is I have a pool of money then. So we take my monthly benefit. Let's say it's this $6,500. All right. let me use a different number that I know. Let's say it's $5,500 a month benefit, and I want this for 3 years. So you take 5,500 times 36 months gives me a pool of money of $198,000. All right, that's my coverage. If I have my 5,500, but in the beginning, care is usually intermittent. I don't go from being healthy to a nursing home typically. I go from being healthy to a couple hours of care a day or care every other day. So let's just say I have 5,500, but I'm only using 2,000 of it in the beginning. That extra 3,500 that I'm not using stays in my pool of money. I do not lose it. So my 3 years can last longer. It's when the pool runs out, not when the years run out. All right. So I got monthly benefit, I got number of years, which is my pool of money. Now, let's say I'm 55 years old. I buy this policy, but I theoretically, statistically may not use it for 25 years. Well, 5,500 is not going to have a lot of leverage 25 years from now, right? So we add inflation protection to that. So typically what we recommend is 3% inflation. So that's going to take my 5,500 in like 20 plus years, it's going to double it. So when I go on claim, now I'm at like $11,000, not 5,500. All right. And then I have an elimination period. That's like a deductible on a car. How soon do I want Mutual of Omaha to start paying my bills? All right. Do I want, typically most carriers use 90 days. We do have, and I'll get to it, riders. You can make it 0 day and things like that. And we'll get to that in a minute. But that's what the elimination period. So there's your 4 working parts. All right. So now you have the basics. So now our portfolio, we have 2 products. We have secure and custom. And we just say, go with custom. Make it simple, make it easy. It's the product that's better and it has more options. It has some things built into it that are free that are very valuable. So we're going to stick with custom as we go through this. Now, something we have with both products is we have a cash benefit. So I'm talking about that monthly benefit. Again, let's just use the 5,500 I was using. And again, we're back to intermittent care. In the beginning, we're reimbursement. All right. And typically reimbursement means you have to use an agency. Now, we have in ours that if I can use 25% of my monthly benefit to pay somebody cash, but that's all I'm going to get then is that 25%. So let's just say whatever that number is, I got $2,000 I can pay somebody cash. I can pay my wife, I can pay my adult children, anybody I want, I can use that cash benefit. That's used a lot. That's a big deal in our policy. And yes, that 25% does grow with inflation. All right. So we go to, well, rookie mistake there. Sorry about that. Um, we go to age 79, except in New York, where we go to age 75. Can't we go down to age 30? All right. Now, tax qualified plan, you've got secure here in the middle. It only has a 2 year, a 3 year, and a 4 year benefit. Where custom, I can make this 2.5, 2 3/4 years if I want, 3 1/3, whatever, 4 or 5. I can even go out 6 or 7 years, depending on what my monthly benefit is. So I have a lot of flexibility over here on how many years. Now, on both of them, I can go up to $15,000 on my monthly benefit. 15,000. And we increased that a year or two ago for the sole purpose of New York, New Jersey, Connecticut, where it's more expensive. All right. Now, I'm not going to encourage anybody to use 15,000, especially if you're going to unless you're not putting inflation on. All right. You're just going to price yourself out of this. You've got to make it affordable. And we'll talk about that in other situations. But we do go up to 15,000. Now, secure, I only have a 90-day, 180, 365-day elimination period. Over on custom, I can make this 0 day if I want, that we pay immediately. Now, I can also make it where it's just 0 day for just home care. Now, I'm not a fan and don't typically add either one of those. I don't think the value is there. I think it's too expensive. And the value prop of traditional long-term care is it's very good coverage and it's less expensive and you get better leveraging than any other long-term care product in the marketplace, right? With traditional. So I don't want to add things unless I really need to or the client prospect wants it for sure. But we do have it. 0 day home care, I can make it 30 or 60 days. Now, waiver of premium. Well, let me go touch on this one. I will hit this. International benefit. I can use this product anywhere in the country, anywhere in the world, basically, that, and I get to use it for 365 days. So if I have a 3-year policy, I can only really use this theoretically for 1 year outside of the United States. Except I can use my full benefit for Canada, Puerto Rico, all US territories, and believe it or not, even England, I get full benefit. But other countries, I get 1 year. But unlike other carriers, I do get to be able to use it for home care, assisted living, and nursing home, which is unusual. We also get full benefit. Most carriers reduce the benefit because it's international. So we do not. So we do have international coverage built in free. Waiver of premium is included. I go on claim. I'm through my elimination period. I I don't pay premiums anymore. Now, and let me back up for a second. On the cash benefit here, I can go on the cash benefit and my elimination period, I don't need to use it. I can do that immediately. We can have a family member help right away. But if I do that, and now I need more care, need to use more money to pay for my care, I do have to stop and satisfy my 90-day elimination period. I forgot to touch on that. All right. Shared care, I'll touch on in a minute. Joint waiver of premium, I suggest adding this every single time. It's very inexpensive, and it's exactly what it says. If I go on claim, my wife's premium's waived. She goes on claim, same thing, mine's waived. All right. It's very inexpensive. It's like $150 a year, and you get a ton of mileage out of it. People love it. Always add it. Right here on inflation, on secure, I don't have a lot of options, 3, 4, or 5. Over here on custom, I can go all the way down to 1%. So I can go one, I can go in 0.25 increment. So I can go 1.25, 1.5, 1.75, 2 3/4, whatever, between 1 and 5. Much more flexibility. I'm big on using 2% inflation personally for middle class people. All right. Now, here's another big one. Pay attention to this. Typically, your inflation with most carriers, you just pay it until you pass away or until you go on claim. But we have the ability to reduce that. All right. The inflation option, the duration. I can have it stop after 20 years, that inflation, or after 15 or 10. So here's the sales idea around this. If I'm talking to a 60-year-old, remember what I said? What age is the average claimant? Age 80. So if I'm talking to a 60-year-old, I can have the inflation stop after 20 years, and I feel good about that. It's probably going to save a couple over $1,000 a year in premium, 1,300, something like that. My inflation stops at 20. It saves me premium. But I get to my age where I typically go on claim. If I go a little bit past that, that's okay. I'm close. I'm talking to a 65-year-old, I can do 15 years. Now it gets me to age 80 or 10. So it's a good way to keep the premiums affordable. All right. That's a big deal to utilize this. A lot of people aren't aware of this, or if they do their own illustrations, don't do this. All right. Here's a big one. No multitasking right now. Pay attention on this one. This is unique. We have what we call the buy up or buy down. So with that, I can increase my inflation on policy anniversary with no underwriting. Yes, I can buy more coverage with no underwriting. Very unusual, right? So that being said, um, the take a here's a sales idea. I'm 55 years old. Remember, sweet spots around mid 50s. All right. If I have a book of business, I'm going to sort my book age 50 to 63, 64. That's where I would start. I can go beyond that, but that's where I'd start. I'm talking to a 55-year-old. What do you think the objection might be? Hey, John, we got kids in college. This is kicking our butt. Can we wait, in like 6 years, they'll all be out of college. We'll have more disposable income. Well, here, I got an idea. Here's what we're going to do. We're going to take your inflation from 3% down to 1. I have to have something on there for this to work. Now, you mentioned, so and that's going to save like $3,000 of premium on a couple. You mentioned at age 61, you'll be good. At age 61, what we'll do is we'll increase your inflation on policy anniversary, no underwriting, and just up it to 2 or 3%. We'll go to 3, or maybe we go to 4 and play catch up for a few years and then bring it back down. And all you're going to do is pay for that extra coverage at age 61. You've locked everything else in at age 55. That's a huge deal. Nobody else allows you to do that. It's called the buy up. It's built in custom only, and it's free. People love to know too that in retirement they have just this flexibility. I can go up or down. I can go down with it also. Now, the caveat to this is I can only go up for the first 20 years or until I hit age 75. Whichever comes first, then I'm locked in. I can't go up higher anymore. I can any age I can reduce it though. All right. Here's another like kind of a sales concept with this and why you should talk about this to everybody. Let's say Mr. Jones has a stroke at age 70. He's not ready to claim yet, but he's going downhill. He's age 70, and let's say he has 3% inflation. Here's your sales idea. Mr. Jones, I heard you just had a stroke. We want to adjust your policy on anniversary to 5%. Like what? Why would you do that? Here's why. Your premium is going to go up at your current age, right? So maybe you pay that for 6 months or a year. You go on claim, your premiums are waived. You bought more coverage, and your benefit's going to grow by 5% while you're on claim still, but you're not paying for it. So you bought more coverage. All right, I'll call it a little bit of a loophole. Next, some additional benefits to think about. Shared care. This is a big one. And here's why. We as males think we're invincible. We think it's not going to happen to us. But you know what? I always say, Mr. Jones, men get ALS, men get MS, men get Parkinson's, they get dementia. I'll have a long tail on it. But here's the thing. If we do a shared plan, I have 3 years, my wife has 3 years. The policies have to be designed identical. Same coverage, everything. We connect them with a rider. So now we have 6 years to share. My 3 here. So Mr. Jones, your concern is you don't use it. If you don't use it and your wife goes through hers, she can come over to yours and utilize whatever's left, all of it, or if you only used a year, she's got 2 years left. We as males love that because now we think we're taking better care of our wife if we don't use it. So that's a big deal. And also, if that happens, my coverage is less expensive than my wife's because women go on claim more often and longer. They're more expensive. But now I potentially bought her more coverage at male rates. It's a big deal. So that's one thing. Next is a security benefit. This is another one that's unique to us. My wife and I apply, but she gets declined. Or like my mother had MS. She wouldn't be eligible to apply. So we put security benefit on the healthy person. So let's say I'm the healthy person. It's 60% more premium for me, but that's okay. Still less than both of us buying this. And then 60% less premium. When I go on claim, the healthy one, I get 60% more benefit. Cash, no receipts needed. So, an example, I have $10,000 monthly benefit. I go on claim. I'm using all 10,000. Excuse me. I get another 6,000 cash. Do whatever I want with. Again, no receipts. I can use it every month. I'm going to get that. I can go buy a new car. But theoretically, it's there to take care of my unhealthy wife. Now, let's say, she just couldn't get this, but doesn't need care right now. Bank it. End of the year, I've got $72,000. End of 3 years, excuse me, end of 3 years, I have $210,000. Okay. Next, professional home health care. Excuse the coughing, I apologize. This is inexpensive. In all honesty, I'm a little on the fence on this one. There's sometimes I get the value. If somebody's not worried about the premium, you don't have premium sensitivity, I think this can work. It's got value. I just like to keep the premiums low. Professional home health care means I can double my premium. I get another, if I have 10,000, I get another 10,000 a month, but it has to be for professional care. All right. So that would be a nutritionist, a physical therapist, things like that, not just for regular care. I also get access to a full nurse for intermittent care for like 365 days. It only costs 3%. So it's very inexpensive. So people that are like seasoned veterans in this will utilize that at times. Again, if there's no premium sensitivity, I think this could make sense. Next one, return of premium. Some people will say, hey, John, what if I don't use it? Well, most insurance is like that, right? But we do have full return of premium. If I'm age 64 and below, I can get 100% return of premium, less claims, and it's reasonably priced. I have to buy at age 64 and below. But here's my answer to that at times. You know, it's kind of like the difference. This is pure insurance versus asset-based type products with the life insurance. It's term versus permanent. And here's the other one. So I have advisors at the time go, yeah, well, but what if you don't use it? I don't like that part of this. Well, let me ask you a question. Have you ever sold a term policy to a client? I go, yeah, I've sold a lot of term policies. Okay, really? What are the odds they're going to use that term policy? And then they get it. The answer is 2 to 3%. That's it. But you have no problem selling that. I guarantee the odds of using a traditional long-term care policy is infinitely higher. All right, so let that objection go away. All right, pay attention here. Home certification. We are the only reimbursement that has this. This is a huge deal. I'll call it another loophole. So I go on claim. Now, this, I don't want to confuse you. This is completely separate from the cash benefit, completely separate. I have my full benefit. We have a loophole that I don't have to use an agency if I have a caregiver that took the time to go to, let's say, night school at the community college for 3 nights, for 2, 3 hours a night, walked away with a certificate. We let you pay that person cash, and then we'll reimburse you. So you just document for the month. I had John Doe in here for 2 hours on Monday, 3 hours here, whatever. Submit it, and then you decide what you want to pay up to your monthly benefit. Now, the key to this would be, hey, I could pay somebody instead of $60 an hour in an agency, $30 an hour cash, and maybe it's somebody I know. It just cannot be a family member, not a family member for this part. All right. And then my money will last longer, and maybe it's somebody I know. That's a huge deal. I can kind of make this look like indemnity. All right. So here you go. All right. Right here is something we call common employer program. If I have 5 or more employees apply at once, they get a 5% discount. 5% discount. But 5 or more have to apply together. After that, they can trickle in one at a time. So you got maybe a doctor's group, a law firm, and the spouses also get the discount, but they just don't count towards the 5 employees. So that's a program that's out there that you may want to be able to utilize at times. All right, partnership. Some people dismiss this. We don't have it in New York. We do not have it in Connecticut. It is in New Jersey, next year in most other states. So if you're not familiar, partnership is a partnership between the state and the federal government. They say you buy a long-term care policy, you can protect assets. Excuse me. So let me give you an example. I have that benefit pool, $200,000. I go on claim. And I use all 200,000. Now I'm out of that. I got to use my own assets. From that, I spent, let's say I have a 500,000 net worth with my home equity. I could spend down my assets to 300,000, leave 200,000, set it aside as a legacy for my adult children. If I had a 300,000 pool of money, I could hide 300,000, set it aside. I shouldn't say hide, but set it aside. Some people dismiss this. I do not, because I lived through it. There is value. I grew up in a blue collar family, south side of Chicago. My parents worked hard to take care of us, but my mother had MS for 40 years in a wheelchair for the last 20. My dad, his whole retirement was a caregiver, and myself and my 4 sisters would help. But at one point, he realized that when he passes away, we would have to use the home equity to pay for my mother's care, which is exactly what happened. And then we went through it, and we ran out of money. And she ended up in a nursing home on Medicaid. All right. On Medicare. On Medicaid. Sorry, I read the first time. Medicaid. Point being, so fast forward or back up. When my father realized we'd have to use the home equity, he was devastated. He wanted that to be their legacy to me and my 4 sisters. His father was blue collar and did that for he and his siblings. This is a big deal. So it's free. all you have to do is do the inflation protection correctly by state, and that's what this chart showed. So for New Jersey down here, it has to be at least 3% to 5% inflation. And Michelle and the team can help you. So when I talked about 20-year, 15 and 10-year inflation things, those won't qualify in New Jersey. They will in all these states up here. So this is something, if you're talking to middle class people, is a big deal. Upper middle class could be. Affluent, it doesn't matter because they're not going to go on Medicaid. But partnership, big deal. All right, next, care coordinator. Position this like it's a concierge service. Care coordinator, they're employees. I think we have 5 of them. They're nurses by education and no claims inside now, a ton of experience. So what happens is when if I went on claim, let's say my daughter calls in, they would get a care coordinator, would guide her through the process, help them all the way through it, give them 3 reputable in-home companies, 3 reputable assisted living, 3 reputable nursing homes, whatever it is. And take that when the rubber meets the road, takes the pressure off. And this is a big deal. I had a neighbor one time, her husband was passing away from lung cancer. He didn't smoke. She did all day long. So I go over there one day to help her. Her husband was in the hospital. She would hit the wrong button on her TV all the time. I'd go over, hit the button, walk out, leave, and my kids would go, "You're at Mrs. H's house, weren't you? Because you smell like smoke." I could be there 2 minutes. I walk out, I had to change my clothes. Anyways, she says, "John, my husband's going to be coming home basically to pass away. I don't know what to do." She had 2 kids, sons that lived in the area, did absolutely nothing to help. She had a daughter that lived an hour away. She and the son-in-law would do everything, but she didn't know what to do. I'll never forget it. I remember thinking, I gave her some ideas, but I remember thinking, this is where the care coordinator would say to her, "We got this. We'll have somebody put a bed down here on the first floor. So he doesn't have to be upstairs and you don't have to be keep going up and down to keep an eye on him and whatever else." I guarantee she still had problems, but she'd have slept a lot better. This is a big deal when rubber meets the road. And here's what we do, and you would talk about it. If I call in and Melissa's my care coordinator, every time I call in, I get Melissa. Melissa knows me, knows my family, knows the situation, the story, doesn't have to look through notes every single time I call in. That's a huge deal. This is a big deal. This is what talk about showing the value of everything. All right. Couples discount, 15% if both apply, 5% if only one applies or only one's appointed. Now we have a 15% preferred health discount. Pay attention. Do not quote it. It's hard to get. Only 18% of you people get it. All right. Let it be a surprise. The last thing you want to go out is with 15% more premium. We have association discount, producer discount. You want to buy it on yourself. They may ask, "Hey, what's your policy look like?" We give you a 5% discount and a spouse partner also. If you're talking to same-sex couples, they have to live together 3 years sharing expenses, and they get the partner discount. All right, here's a big one. This drives me nuts. We're almost done. People just don't pay attention to this as advisors. You can sell this all day long to business owners. If it's a C Corp, it's 100% write-off. And for my wife. So if it's my C Corp, I have the company write the check, then Mutual of Omaha, does not hit my income. And unlike disability insurance, my benefits are still tax-free for long-term care. Now, And my wife I can write off my wife's also. If I'm a pass through, LLC, that's not a C corp, a S corp, partnership, sole proprietor. I sell widgets on eBay. I work for myself partly. And maybe I'm a teacher, but I do that on the side. I have my own business. I can go by this chart now. So if I'm in a sweet spot, 51 to 60, 1860 for me, 1860 for my wife if she's in the same bracket. Doesn't have to be doing anything. 61 to 70, almost $5,000 each. It's an easy conversation. Mrs. Business Owner, are you familiar with the tax favorability of long-term care? Know what you're talking about. We need to set up a meeting. It's my job to make sure you're aware of everything. That easy. All right. You can use HSA money, MSA money to pay for this. Underwriting, we have a really good field underwriting guide. Utilize it. Do your field underwriting. We'll talk about that more in other ones, but do your field underwriting. Let me skip that in the spirit of time. Just the big thing here is our cycle times are way down in the way we do our underwriting now. We've reduced by 40% the number of medical records we ask for. We reduced by 40% number of phone interviews. If somebody's under age 60 and they're healthy, we can waive the phone interviews and the medical records and they can be approved in 3 to 5 days. Our cycle times are like 30 now. The days of 90 days to get a medical records, those are the outliers now. So this is something, one of my, an agent I work with uses this. This is pretty extensive field underwriting guide. I think it's more than what most people need, but if you want this, we can get this to you. Quoting tools, you can quote on WinFlex. You can use a mobile quote. We have one on our website, but you can't download anything from it. In the beginning, maybe work with Melissa till you know better. And we're going to do a session on how to craft an illustration. We have some marketing pieces online on our sales professional access. Melissa can help you with that. You have a prospecting letter. You could take this, use that, or create your own. Maybe plagiarize a little bit of this, or AI. Consumer video that talks about the need. It's short, like 3 to 5 minutes. You don't need that. All right. Before I hit this last slide, Melissa or Bobby, you had a couple questions in here, or are we good? I think I see a couple.
Well, let's see. Let me double check the other section. In the chat section, I don't see anything, John, but let me look in the Q&A section, and
Okay.
we're kind of running both of them. I do not see any open questions, John.
Okay. So you must handle. I see something that says 2 questions in here, but you guys probably handle them. All right.
Yeah, I think it's because I put a couple things into the chat.
Yeah. Oh, gotcha. Perfect. All right. So here's the deal. You just invested 45 minutes of your time. Hopefully you took some gold nuggets out of here. You've got great resources here to help you. Now, if you have a book of business, sort by 50 to 65 and start being proactive with this. Think about in your book of business, females in their 60s and 70s, single female. I guarantee you to word about it. They don't know they can get it. We go to age 79. Just do your field underwriting. Business owners, tax advantages, wealthy clients will do this. Some will summarily shut it down. Many of them understand the concept of other people's money, leveraging, and pennies on a dollar. They will do it. All right. So the key down here at the bottom is be proactive, not reactive. And on the last comment I'll say, and turn it back over to Bob to close it, is think about who you're going to meet with over the next 2 weeks. All right. And then get with Melissa and together craft an illustration for those meetings and be proactive with it and bring it to there. And with that, Bob, I'll throw it back in your lap.
All right, it's in my lap. John, thanks a lot. Appreciate it. Thanks for that. So John set the stage for the next couple of sessions that we're going to have, which is going to go beyond product. It's going to talk about more about having the conversation and so forth. So hopefully you can join us for that. I don't see any questions. This is your last opportunity. So if you do have any questions on anything that John covered, now's your opportunity to type those in, either preferably into the chat. That's what I've got open, but I'll check Q&A as well. Before we begin to wrap up, Melissa, anything you wanted to add to John's comments?
Not really. A great presentation, John. I appreciate it. Certainly the tax play, especially, for business owners, but also for the state. So state tax credit in New York is awesome too, and you can layer the
Oh,
two of
yeah.
them together. I love the independent informal care aspect that is baked into the contract as John discussed. Also, do keep in mind the security benefit that John did a commercial for is not available in New York State. So just be cognizant of
Right.
that. Yeah, when in doubt, come to us. Jen and I can certainly help pre-qualify your clients for LTC. We have an awesome, simple, fillable pre-qualification health form. It's a one-pager that you and or your clients can quick type in their information, shoot it over, and we can let the probability of being insured, and if so, what class, and take it, from there for you. But I'm looking forward to certainly the next sessions that you have coming up, John.
Well, thank you.
Yeah, can't reemphasize enough the importance of pre-underwriting. I mean, one of the things that we even to this day still hear is, oh, geez, everybody keeps getting declined. Well, it's a little bit of an exaggeration. Not everybody gets declined, but the better job that you can do in gathering some medical information before you put pen to paper, literally or figuratively through electronic means, the better off you're going to be in identifying things before you get to that point. Reach out to Melissa, reach out to Jennifer. They both have a good understanding of any medical conditions, any medications that might be problematic in the underwriting process. Physical therapy is one that comes up on a regular basis. Just because somebody's going through physical therapy, hey, they're on the mend, right? Well, insurers don't like, generally speaking, like the fact that somebody's going through physical therapy. They're going to delay that person for a period of time post therapy to make sure that everything is okay, as a general rule. So you knowing that and your client knowing that up front could save you some aggravation rather than going to application right away. So can't emphasize the importance of that tool that Melissa can provide to you on that. Esther asked a question, can we get the slides? Hey, if John gives them to me, I'll give them to you. So if John forwards those to us, we'll make sure to share it with everybody who was registered today. John, I'm going to give you the last word then, because it looks like no other questions online. So, hey, thanks again. Anything you want to finish with?
One thing I'll say, yeah, you talked about underwriting. We only decline 19 or 8, actually down to 18% of applications. People think it's like 50% or something. It's 18%. That's it. So do your field under, it's fine. Even in their 70s, we approve 50%. So yes, and I will get you the PowerPoint. And thank you very much, everybody.
Sure thing. Thanks a lot, John. And I think Melissa would attest to the fact that Mutual Omaha has come a long way in terms of the timing of the underwriting process. I mean, the time from application to having a policy in your hands is better than it's ever been. So that's refreshing as well.
Yeah.
Hey, John, thanks a lot. Really do appreciate it. Melissa, thanks for tuning in as well. Anybody got any questions? I think everybody knows how to get a hold of Melissa, but you can go to advisorsib.com and all of our information is out there. So if you need any follow-up help, glad to help you. Hey, let's go write some business, gang. There's a lot of people out there that need your help. Let's make sure they're aware of what you do and that you're reaching out to help them. John, thanks a lot. Thanks, everybody.
Yeah.
Have a great week.
Take care.